Good morning. Let's turn our attention to a retail giant, a name synonymous with American shopping for generations. For many, JCPenney is more than a store. It's a piece of American life, woven into our memories, a familiar landmark in countless towns and cities. It represents a shared experience, a common thread in the fabric of our consumer culture. Maybe you remember your first suit, carefully chosen for a special occasion, or perhaps the annual back-to-school shopping trip, a rite of passage marked by new clothes and fresh starts. These moments, big and small, helped define JCPenney's place in our lives. For over a century, JCPenney anchored malls and main streets, a reliable presence that drew shoppers and defined retail landscapes. It was a cornerstone of community commerce, built on James Cash Penney's golden rule: fair value and honest service. His philosophy wasn't just about selling goods, it was about building relationships and trust with customers. But retail changed, evolving at a breakneck pace, leaving some traditional players struggling to adapt. E-commerce and shifting tastes left JCPenney struggling to keep up, facing fierce competition from online retailers and rapidly changing consumer preferences. The digital revolution presented a formidable challenge. The company cycled through leaders and strategies, each attempting to navigate the turbulent waters of the modern retail market. But financial pressures mounted, exacerbated by increasing debt and declining sales. The weight of these challenges grew heavier with each passing year. In 2020, the pandemic and heavy debt forced JCPenney into Chapter 11 bankruptcy, a stark reminder of the vulnerability of even the most established brands. A humbling moment for a retail icon, a symbol of a bygone era grappling with the realities of the 21st century. Bankruptcy wasn't the end, but the start of a tough reinvention, a chance to shed old skin and emerge anew in a changed world. The company was acquired by Simon Property Group and Brookfield Asset Management, a surprising turn of events. Its biggest landlords who wanted to keep their anchor tenant alive, recognizing the vital role JCPenney played in attracting shoppers to their malls. This unusual move gave JCPenney a lifeline, a chance to restructure and redefine its future. Shedding debt and starting a complex rebuild amid a global crisis, a testament to the resilience and determination of the brand. The journey out of bankruptcy was a fundamental restructuring, not just a restart, requiring a complete overhaul of its business model and a renewed focus on customer needs. Now, JCPenney faces a new crossroads, a critical juncture in its long and storied history. With its future hanging in the balance, dependent on its ability to adapt, innovate, and reconnect with the American shopper. The path ahead remains uncertain, but the stakes are undeniably high. Today, July 30th, 2025, a significant announcement ripples through the business world. It's a day marked on the calendar for a decision that could redefine the future of a retail giant. JCPenney has announced a massive deal, a strategic maneuver designed to reshape its financial landscape and operational focus. This isn't just a minor adjustment, it's a fundamental shift in how the company manages its assets. The deal involves selling 119 stores and 6 distribution centers for a substantial $947 million. This influx of capital represents a major financial event for the company. This is a major shift, a calculated move to unlock capital and streamline operations. It signals a new chapter in the company's long history. JCPenney is moving from owning its stores to leasing them, a strategic decision to free up capital tied to real estate. This transition marks a significant change in their asset management strategy, focusing on retail, not real estate. The company aims to sharpen its focus on core retail operations, enhancing customer experience, and optimizing merchandise offerings. The buyers are real estate investors, not retailers. These firms specialize in managing and maximizing the value of commercial properties. They want the property, not the brand. Their interest lies in the long-term value and potential of the real estate assets themselves. This is a sale-leaseback, a common financial strategy where a company sells its assets and then leases them back from the purchaser. JCPenney sells the buildings, then leases them back to keep stores open, ensuring continuity of operations and minimizing disruption to its retail network. For now, nothing changes for customers or employees. The immediate impact on day-to-day operations is minimal. Stores stay open, business as usual. Customers can continue to shop at their local JCPenney stores without interruption. But JCPenney is now a tenant, shifting from property owner to lessee, paying rent and giving up control of key assets. This new financial structure introduces ongoing lease obligations. The deal injects nearly $1 billion in cash, providing a significant boost to the company's liquidity, providing immediate relief. This infusion of capital can be used to pay down debt, invest in growth initiatives, or improve operational efficiency. But it also adds long-term lease obligations, creating a recurring expense that must be factored into future financial planning, and surrenders valuable real estate. The company no longer benefits from the potential appreciation of these properties. Analysts are split. Is this a smart pivot for agility, a strategic move to adapt to the changing retail landscape, or a desperate move to cover urgent needs? Is this a sign of financial distress, or a calculated risk to secure the company's future? The answer will unfold in the years ahead. Only time will tell if this decision proves to be a masterstroke or a misstep. For now, it's a bold gamble, a high-stakes bet on the company's ability to thrive in a competitive market, to buy time and stability. The immediate goal is to provide the company with the breathing room it needs to restructure and innovate. The company's future depends on how it uses this opportunity. The key lies in effectively deploying the newly acquired capital and adapting to the evolving retail environment. The stakes couldn't be higher. This decision represents a critical juncture for JCPenney, with the potential to either revitalize the brand or hasten its decline. So, how exactly does this sale-leaseback arrangement work in the world of retail real estate? It's a financial strategy that's becoming increasingly common, but the mechanics can seem a bit complex at first glance. Let's break it down. Imagine selling your own house, the place you call home. Then, imagine renting it back from the new owner, essentially becoming a tenant in your former home. You get a lump sum of cash from the sale, which is great, but you now have a recurring rent payment to make each month. JCPenney, the well-known retail chain, is implementing this strategy, but on a massive scale, involving a significant portion of their real estate portfolio. This involves a whopping 119 stores across the country, a substantial footprint in the retail landscape. And it also includes 6 distribution centers, which are critical hubs for their supply chain and logistics operations. The entire process involved months of careful valuation to determine the true market value of the properties, intense negotiation to reach mutually agreeable terms, and extensive legal work to ensure all aspects of the deal comply with regulations and protect the interests of all parties involved. Once the deal officially closes and all the paperwork is finalized, JCPenney immediately signs long-term leases with the new property owners, securing their continued use of the locations. The stores remain open for business as usual, and the employees continue their work without interruption. The only significant change is that JCPenney is now obligated to make regular rent payments to a new set of landlords, the real estate investors who now own the properties. This type of financial maneuver isn't entirely new or unique in the retail industry. In fact, other struggling retail chains have turned to sale-leasebacks as a way to unlock capital and improve their financial position. It's a strategic move designed to raise much-needed cash. Ultimately, it transforms relatively illiquid real estate assets into readily available liquid funds, providing a financial boost. This allows JCPenney to operate as a more agile, financially lighter, and less burdened company, theoretically freeing up resources for other strategic initiatives. On the other side of the equation, the real estate investors are making a calculated bet on receiving a steady stream of rental income over the long term. Their investment hinges on the assumption that JCPenney will continue to meet its lease obligations, regardless of the ups and downs of its overall retail performance. For JCPenney, this represents a significant strategic shift in their approach to asset management and financial planning. It means less direct ownership of physical assets, which translates to more operational flexibility and corporate agility. However, it also introduces a greater degree of financial risk and reliance on external factors. The long-term viability and future of these stores now depend heavily on the terms and conditions outlined in the lease agreements, rather than on the traditional security of owning the property outright through property deeds. Nearly $1 billion sounds like a windfall, but where does it actually go? Not to store upgrades or new products. Instead, it pays back the lenders who financed JCPenney's bankruptcy exit. When JCPenney was in crisis, creditors provided a lifeline, secured by the company's real estate. Now, the sale proceeds are legally obligated to pay off that debt. For creditors, it's a solid return. For JCPenney, it's about cleaning up the balance sheet. This isn't a growth fund. It's a debt settlement. The benefit: JCPenney looks financially healthier, which could attract future partners or investors. But don't expect overnight transformation in stores or online. Future investments will have to come from actual sales, not this one-time cash event. This move is about settling old obligations, not funding a retail revolution. The real test for JCPenney starts now. What does this mean for employees and shoppers? For the 119 stores in the deal, operations continue as usual. No immediate closures or layoffs. Employees keep their jobs, customers see no change. The sale-leaseback is designed for continuity, making the ownership change invisible to most. But as a tenant, JCPenney's future in each location now depends on lease renewals. If a landlord wants to repurpose a property, a store could eventually close. For now, stability is the message, but long-term uncertainty is real. The company must keep customers confident and employees engaged. The real challenge is maintaining relevance while navigating this new dynamic. The pandemic accelerated retail's transformation, pushing JCPenney into bankruptcy and forcing tough decisions. In 2020 and 2021, JCPenney closed 175 underperforming stores to survive. The current sale is different. These stores stay open, but the move is part of a broader trend, the Great Retail Reset. Retailers are rethinking the value of owning real estate. What was once an asset is now often a liability. JCPenney's sale-leaseback is a response to this new reality. Other chains like Macy's and Sears have made similar moves, selling real estate and shrinking footprints. The American mall is being reinvented. Department stores are giving way to new uses. JCPenney's deal is another chapter in retail's ongoing transformation. The future of physical retail is being rewritten one store at a time. Who's in charge of JCPenney now? Since 2020, it's privately owned by Simon Property Group and Brookfield Asset Management, two mall giants who saved their anchor tenant. Their goal? Keep JCPenney alive to protect their malls. CEO Mark Rosen leads day-to-day operations, focusing on value and quality for working families. The board includes Simon and Brookfield reps, aligning strategy with landlord interests. This unique structure could spark innovative partnerships and smarter store strategies. The challenge: balancing real estate priorities with retail needs to secure JCPenney's future. With debt reduced, JCPenney has a chance to refocus. The strategy returned to basics, serving middle-income families with value and reliability. Private brands and core categories like home goods and jewelry are the focus. But competition is fierce from department stores, off-price chains, and e-commerce giants. Long-term leases mean fixed costs. If sales drop, risk rises. Success depends on flawless execution, great products, service, and a seamless digital experience. The sale is a financial reset, but the real test is winning back shoppers. JCPenney has bought time but must now prove it can thrive. The next chapter will be written on the sales floor and online. JCPenney's $947 million sale isn't a simple win or loss. It's survival in a tough retail world. The company traded real estate for debt relief, prioritizing stability over ownership. For shoppers and employees, stores stay open, for now. But as a tenant, JCPenney faces new long-term risks tied to lease renewals and landlord decisions. This is a pivotal moment, a second chance to revitalize the brand and reconnect with customers. The real measure of success will be loyal shoppers and ringing registers, not just financial engineering. JCPenney's story mirrors the transformation of American retail: legacy, struggle, and the fight for relevance. The outcome depends on what happens next, and the choices of the American consumer.